ଦୁଇଟା ପିପିଟି କରୁଛି, ଗୋଟେ ବନ୍ଦ କରିଦେବି। क्लिक कर लो। शेयरिंग का स्टॉप पर क्या उतरे करना है, और क्या उतरे करना
सिस्टम में हैंग हो जाता है।
छाड़ दिए तो बिना स्लाइड रे कर दूँ। Welcome to today's class on the financial engineering, which talks about the various innovations in the domain of the financial market. Now, if you look at the concept of engineering, now what is this engineering? Engineering is the process through which we add some kind of value to the raw material or semi-finished product so as to make this useful to the users or the end users or the consumers. Now, if we that means we talk about the input, the raw material as the input, then we process it in the I mean, in the phase of processing, we add some value to the raw material, and then we produce the end product, which is the finished good. So basically, the raw material gets value added into a finished product. Similarly, the concept of financial engineering is, if we apply this particular concept to financial product, then financial engineering is basically the process in which the finance managers or the various intermediary institutions, they add value to the existing base products and create new kind of product. So if you look at the definition of financial engineering given by John Finnerty, then financial engineering, it involves basically the design, the development, and the implementation of innovative financial instruments and processes, and the formulation of creative solutions to problems in finance. So basically, if we have some plain vanilla products, which are basic kind of products, and if we want to, and those plain vanilla products don't fulfill our needs and requirements, then we can re-engineer, we can redesign the product through the process of engineering, and okay, so we can redesign the product so that actually the need of the customer can be, or the consumer can be met. So that is the process of designing the products through financial engineering. Now, who are the users of this financial engineered product? The users are basically the retail investors as well as the institutional investors. Now, in institutional investors, we can talk about the pension funds, the banks, the financial institutions, the various corporates, the mutual funds, the government, the employers, and all these things. They're the end users of the financially engineered product. You see, now, if you look at the concept of the equity and the debt. Now, equity is a product which is a high risk product, and because it is a variable income, whereas debt is a product which is designed to be low risk and yields a low rate of return. Now, the point is, equity is on the one end of the continuum, like the high risk and the high return, and debt is a low risk and low return kind of a product. Now, what if someone, he wants to minimize the risk and at the same time he wants a slightly better return? So to combine these features of equity and debt, you can design a hybrid product, and essentially the preference share, which is a hybrid of the equity and debt, this is the example of the first financially engineered product. Now, if you look at the preference share, which has some features of the equity, such as they get to share in the profit of the company, so they get dividend, and some of the preference shares, they have voting right. And if you look at some of the features of the debt, like the debenture rate is, I mean, sorry, the dividend rate is fixed, and there is a certain tenure of the preference capital. So some features of equity and some features of debt, they have been combined, and this is the first example of the financially engineered product. Now, you see, when we talk about another example of a financially engineered product is the convertible debenture. We have discussed about the convertible debenture in some of the previous sessions. Now, the point is, the convertible debenture, it is a product which continues to remain behave like a debenture or a bond for the initial period of a life, whereas when the situation or the equity, the company's performance improves and the equity prices increase, then the investors have the option of converting them into equity shares, so they enjoy both the benefit of the fixed interest in the initial years, and when it does well, then they can convert their shares into equity in order to get the higher returns. Suppose your company does not do well, then your option, you have the option of not converting into equity share. You continue as a convertible debenture and continue to get the fixed interest rate. Now, the point is, these are the examples of the initial financially engineered product. Now, we'll talk about why was this needed. I mean, uh, which were the factors that were contributed to the now these days we are seeing lot of financially engineered product. Now we will try to find out like what are the factors that contributed to the basically the um, requirement of the of development of this financial engineering product. Now you see the first factor that contributed is the tax advantage. Now you see if the interest or the income in the interest income on a bond is a regular income, whereas if you talk about a equity share, the you might get dividend. So if your dividend is your regular income, but the main source of return for an equity share is the capital gain. That means you buy at a price of 50 rupee and you sell at a price of, let us say, 200 rupee. Then the differential, that is 150, is your capital gain. Of course, this capital gain does not happen in 1 year, it happens over a period of time. Now, my point is, there were different rates of taxation, but in the Indian scenario, the regular income would be taxed at the respective income tax rate of the individual who is receiving the in their hand. Now, suppose if I am receiving interest income, which is my regular income, and I am in the 20% tax bracket, then the interest income will also be taxed at a rate of 20%. Now, if you're talking about a high net worth individual, it would be taxed at a rate of 30%. So, if you're talking about a company which is receiving the interest rate, the on an average, the companies pay 35% income tax, so the interest will be taxed at a rate of 35%. Whereas if you talk about the shares, the main income was from the capital gain. That is the differential between the purchase price and the selling price. And if this capital gain, if it's a long-term capital gain that is beyond 3 years, then the taxation rate was used to be 10% only. So the obviously there is a motivation for individuals here to reduce the tax burden. So in order to reduce the tax burden, what can the debt do? Debts come with a feature of regular income in the form of coupon. So the debentures engineered themselves to design something called a zero coupon bond. Now, the zero coupon bond is a bond which does not give you any interest in the interim period. That means you buy the bond and you redeem the bond in 7 years or 10 years time, depending on the tenure of the bond. Now, in the interim period, you don't get any dividend, so you are not paying tax on that. And suppose after 7 years, you whatever is the capital appreciation on that, you will only pay 10%. But that is the example of the financial engineering for to take advantage of the tax differential in the different kind of assets. So that is one factor which contributed the requirement of the public to reduce tax. That is what gave rise initiated the process of financial engineering. Now the same is the case with the many of the mutual funds. Now the preference shares, some of these are the examples of the convertible preference shares. So so many of these things have been developed to take advantage of the tax differential. You can then talk about, let us say, the transaction cost. The transaction costs are usually high. Suppose when you're buying and selling, the transaction costs are very high. At the time of buying, you will pay transaction cost. Similarly, at the time of selling also, you will pay transaction cost. Now you see, suppose a company which has issued a 7 year maturity debenture. Okay. Now at the end of 7 years, the company has to, and the size of issue of the debenture was, let us say, 500 crore. Now, at the end of the tenure, that is 7 years, the company will have to repay the entire 500 crore to the public. Now, the point is, but the company needs, it is growing and it needs the capital. So, when it is repaying 500 crore, it has to go for refinancing. So, the point is, when the company redeems the debenture and then freshly goes for another issue, that is going to cost the company a lot of money in the form of transaction cost. So now what the company can do is they engineer their product to say, let us say they issued if you can issue a long, very long term debenture, let us say 50 year or 99-year debenture, wherein you will embed the call and put option in your debenture, like the any time that the investor wants, the option is with the investor. Anytime the investor wants, he can exercise his option and he can redeem the debenture. And if he finds the debenture to be of a good yielding avenue, then he can continue to hold the debenture. So in that case, the company does not have to redeem the entire 500 crore at one go. In fact, if the customers want to stick to the company and get the interest stream, then it did not redeem anything. So the this is one thing that you can do for reducing your transaction cost. Similarly, now there is a lot of discussion regarding the agency cost. So this agency cost is also a major factor that contribute to the growth of the financially engineered product. Now you see, what is this agency cost? Now these days there is a divorce between the management and the owners. Now, though the legal owners of a company are the shareholders, the operations are in the hands of the board of directors. Now, board of directors are appointed by the shareholders, and they're supposed to run the business in a way which maximizes the value that is of the shareholders. Now, the point is, why would a salaried employee do that? Now, the salaried employee would act in a way wherein his job will be job will be safe and he continues to get his salary. Because if he takes additional risk for getting additional profit, and it will not translate for him into a higher salary. And in the process of taking additional risk, sometimes the risk might backfire, and sometimes whatever he intended to do, because of that that might become a failure. So in that case, he stands a chance of losing his job. So the managers or the director, the employees of the organization or the management of the organization, it will engage in behavior that is just sufficing. Now, this is not in the best interest of the company or the shareholders. So this conflict between the interest of the management and the interest of the shareholder is known as the agency problem. Now, to solve this agency problem, the costs that are undertaken are called as the agency cost. Now, to solve this agency problem and to minimize the agency cost, now various financial engineering was done and various products were developed, such as one such product is the ESOP, is the employee stock option, wherein the employees, for their good performance, they will get a part of the share of the company. So, and the share will come with a certain lock-in period, so that if you are performing well, in addition to a fixed salary, you get to own some of the shares of the company in the way given to you in the way of employee stock options. But options, when you exercise it, you can buy the shares, but the point is you cannot sell these shares in the open market within a certain period. So there is a lock-in period. So the company ensures that the shareholders are either have ensured that the performing employee is rewarded sufficiently for his good performance through these stock options, and also that he sticks to the company because he knows that if he leaves the company before a certain period, then he will lose out on that stock. So he sticks to the company in order to encash the stock. So these are the through this also you can do financial engineering to reduce the agency cost. You can talk about the risk reallocation. Now, this is also a requirement for the companies to engage in financial engineering, because this plays a, you see, for example, you talk about the banks. Now the banks these days, the deposits of the bank, I mean the deposits that they receive. For example, I deposited certain amount of money in a bank. That's a deposit of the bank, and that is a liability for the bank. See, the bank on its deposits gives us a fixed rate of interest. For example, if I put some amount of money in a bank in the form of fixed deposit, for let's say for 1 year or 2 year or 3 year, there are fixed interest rate. Suppose the bank gives me a 6% or 6.5% interest rate, and it is fixed for the entire 10 year. So the bank's outflow, cash outflow on the deposits is fixed, whereas the bank also advances loans to the customers who approach the bank. Now the loans are the assets of the bank. Now on the loans are all floating rate. Okay, so basically what happens is the bank receives a floating income but pays a fixed income. So, to clients like me who have made deposits, the bank gives out the cash outflow of the bank is fixed, whereas the cash inflow of the bank is variable because of the floating rate loans. So now here the bank is exposed to the I mean risk here. Now because these two cash flows will not I mean there will be a mismatch between these two cash flows. So the bank is um, exposed to this kind of a risk, cash flow risk. Now what can the bank do now to deal with this kind of a risk? Financial engineering developed a product called as the interest rate swap. Okay, so wherein the bank can enter into a swap transaction with another bank or another organization, wherein the bank will receive the floating income and will pay out a fixed income. So it transforms the cash flow, in the original cash flow, into a cash flow wherein the bank actually receives fixed and pays out the floating. So thereby allocating the risk between to the bank and the other bank or the other organization. Sometimes we talk about the liquidity. Now liquidity, the requirement of liquidity is also responsible for this financial engineering. Now you see, for example, certain assets are real assets are not very liquid. Okay, the financial assets are liquid but the real assets are not liquid. So the real assets are being packaged into different tranches of security which can be traded, and thereby getting adding some liquidity to the even illiquid assets. Then there are regulatory and legislative factors. For example, I am an investor in India and I want to invest in the US, in US equity. Then the regulations and the various legislations, they make it very costly for me to invest in the US. So the financial engineering developed products such as the ADRs, the American Depository Receipts, and the GDRs, then the Global Depository Receipts. The ADRs and GDRs are which are the financial engineered products. This allows the companies to issue shares in another country. So basically, I get the advantage of investing in the US, but not directly, but through the GDR or the ADR. So the regulatory measures or the legislative measures also comes up with requirement, throws us requirement of the investors for financial engineering. Now the interest rates are volatile. Because the interest rates are volatile, the prices are also volatile. The prices of commodities have also volatile. Now the volatility of interest rate, we discussed that about the bank here. Now because the interest rates keeps on changing, the various prices of various assets like equities, debentures and all that, they will fluctuate. Now the fluctuation in any of these things, interest rate or the price, it exposes the company to, or the investor to, specific risk. So in order to manage that particular risk, financial engineering is needed to deal with this kind of risk. So we have many derivative products developed to deal with the volatility in the interest rate, volatility in the prices of various commodities, or volatility in the prices of financial assets. So we have so many derivatives designed for that. Sometimes the new and value-added product are developed just as a matter of academic exercise. So you are continuously doing a research on some kind of a product, of you're studying the client's requirements, and you're developing doing research and developing some product in the academic sphere, and then it is launched in the market. So that also gives rise to the various financial products. There are accounting benefits, which certain items are carried in a certain way, some are carried in the off balance sheet way. So that is a requirement. Then the technological development is also there. For example, now the life was not very complex earlier, like in the Bretton Woods days, when there was a fixed foreign exchange rate of foreign exchange. Life was not very complicated because export and import was very simple. But now in the fluctuating exchange rate regime, where every day the exchange rate is changing every day, life has become very complex. And along with this complexity, we have many calculations and the very exotic derivatives and various valuation models have become available. So these developments in the valuation aspect, as well as the availability of exotic I mean products, combined with the complexities of life, it has forced the companies to financially engineer and come up with a new product. So these are the factors basically which are responsible for your financial engineering. Then what could be the how could we design the financial engineered product? So if you look at the financial engineer process of financial engineering, the process is the same as the development of a new product. So in the marketing, we really discuss about the development of a new product idea, the product development of the new product new product development. So the idea is basically the same here. Now, number one is you identify or realize some kind of a need. Now, for example, some of the needs we discussed: the need for tax avoidance, the need for liquidity, the various kind of need could exist with the customers. They could explicitly express it, or sometimes they may not express it. You just have to find out what is the need. For example, you see the case of vehicles, automobiles. You see the car manufacturer, they keep on adding newer features into the car to make it lucrative to the some of the times the customers, they come up with the requirement, but sometimes it is also forced by legislation. For example, of late the regulators have made it compulsory that every car should come with a certain number of airbags. This was not the mandatory case in earlier. So the many cars were there which did not carry airbags. Now every car comes with airbags, so you have to engineer a product because of that. So sometimes you feel that the customers give you a feedback that this is required in a car, so you keep on changing, adding new features to the model of the car. So similarly, the corporates or the mutual funds or the investment banks, they continuously interact with the customers and then try to find out where is the gap, where is the requirement of the customer, and say, so they try to design product to fit that particular requirement. So the first thing is you identify or realize some kind of a need. Then you basically develop an initial sketch of the product. So you do certain research on that. So you look at the various regulations, various legislations available, what can you do, what can you tinker with, what can you add. What if this thing is added, so how can we use the various features of different product to this thing. So you develop the initial sketch of the product. Now you test the product to check whether you have to do the testing part. So you test the product to see whether the desired result has been achieved. you can then price the product, what should be the price of your product, and then you actually launch the product in the market. Either you do it through a test marketing, I mean launch in a particular segment and see the success, or then you can change the and then go to the subsequent full market launching. Otherwise you can directly go to the full market launching. We'll now talk about some of the, you see, now when we talk about the financially engineered product, the three product classes that we'll discuss in today's class is basically, see, the fixed income securities like debenture and bonds. The That is the pure one kind of a pure security. The other kind of a security is equity. So obviously we'll discuss some of the equity linked product. Then we'll also discuss some of the preference of the hybrid securities on which the financial engineering is done. Also, as a fourth category, we'll talk about the various financial engineered product in the derivative market as well. Derivative itself is a financial engineered product. In that also, we are having so many financial engineering to develop newer and newer kind of derivative every day. So we will just have a brief look at this product. Now you see, we have seen the one of the in case of fixed income market, the basically we're talking about the bond. I have told you that the first kind of the financial engineering happened in case of the zero coupon bond. So zero coupon bond, there is no coupon in the during the life of the bond. The bond is sold at a discount and is redeemed at par. So basically the differential, suppose the face value of the bond is, let us say, 1 lakh rupees, you can issue, and it is a 10-year bond. So you can issue the bond, let us say, at a price of 40,000 rupees, and you can redeem it at 1 lakh. So the 60,000 is the interest, I mean, is the income for the entire 10 years. So that is how the zero coupon bonds are done. That is one aspect. The second aspect is like the interest rate is fluctuating. So how do we deal with that? So the another concept of let us say a floating rate bond came up. Now, what is a floating rate bond? A floating rate bond is, it gives you the coupon or the interest at a rate which is benchmarked. So the interest rate offered on the coupon offered on a floating rate bond has two parts. One is a fixed part, the other one is a variable part. Now the fixed part is basically the something like a I mean the variable part is something like, let us say, the benchmark, like Libor, or you can talk about the bank rate. So that is the variable part, because Libor keeps on changing every day. So the bank rate keeps on changing, whereas the fixed part is plus 3%. So if a floating rate bond comes up with this particular issue like Libor plus 3% or bank rate plus 4%, so the bank rate is the fluctuating part, 4% over and above that 4% is the fixed part. So the suppose bank rate is 5%, then you will get 5 plus 4 9% coupon in a particular I mean half year, I mean in a particular semester, because usually coupons are given out twice every year, so every 6 months. So half yearly coupon will be, let us say, 9%. Next half year, so your bank rate changes to 5.5%. So the interest given by the bond will be 5.5 plus 4, that is 9.5%. So that is how the floating rate bonds behave. So these are the very simple examples of I mean the financial engineering in case of fixed interest rate. Apart from that, you can have so many things like, let us say, the debt instruments. So many financial engineering has happened. For example, let me give you some of the examples of the financial engineering that has happened in the fixed income part. For example, let us say the bonds which are linked to an index or a commodity price. Now, the interest of the principal that is linked to a particular commodity. We talked about here, like Libor is an index, or the bank rate is an index to which the bond price is linked. The bond price can also be linked to a particular commodity. Now, you see, this is attractive to investors who would like to speculate in the commodity option, but cannot do so because there are regulatory and other reasons for purchase of the commodity directly. So you can do one thing: debentures linked to a particular commodity. So these are called the bonds linked to commodity price or index. Okay. Now you can have auction rate notes and debentures. Now, what is the peculiarity about auction rate notes and debenture is that the interest rate is reset by the Dutch auction at the end of the interest period. So, like Dutch auction is a process that happens where you have a bidding process. So, the um, the coupon based on the length of interest period. Suppose your interest period is 6 months. So the every 6 months your interest rate is reset. Okay, now it has a lower transaction cost than repeatedly rolling over the maturity of the security. Now the interest rate is basically determined by the marketplace rather than the issuer, because that's the auction process. So the bid happens, and the interest rate for every 6 months is decided by the market rather than the issuer. Like in a fixed rate bond, the issuer decides the interest rate, whereas in case of an auction rate note or debenture, the every 6 months the interest rate is reset, and it is done through the auction process, and hence the market decides what should be the interest rate of the, I mean, the auction rate note. You can also talk about the dual currency bonds. Now, in a dual currency bonds, the interest is payable in the US dollar, but principal may be in a currency other than US dollar. Okay, so the principal could be in Indian currency, whereas the interest could be paid in terms of dollars. Now, the issuer has why it is popular is issuer has some foreign currency risk with respect to the principal repayment obligation. For example, if you have a business in India and it has exposure to US dollar, why? Because maybe the corporation in India, it is importing goods from US, or it is exporting its goods to the US. So it is exposed to the income is in dollars, or the payment is in dollars. So the corporation is exposed to US dollar. So currency risk coming from the fluctuation of US dollar to Indian rupee. So this kind of a company can do what is the payment of the principal is in the Indian currency, but the interest is to be paid in the dollar. So the this is a kind of engineered product. Suppose you have, let us say, something called a extendable note. Now, what happens in an extendable note is the interest rate adjusts every 2 to 3 years to a new interest rate. The issuer establishes, and then, every 2 to 3 years you establish a newer interest rate. So the coupon is based on the 2 to 3 year date, and not on the final maturity. So the and this kind of bonds, they come with a put option. That is, the if the investor wants to exercise the option, he can sell the bond at a price which is predetermined. And but if he doesn't exercise and wants to continue with the company with the bond, then he can do so, and the interest rate will be reset every 2 to 3 years. Now, you can have the floating rate tax exempt revenue bonds. You can have the increasing rate notes, where the interest rate, suppose it's a long term tenure bond like 25 years, so every 2 years or 3 years you will have the interest revision. So these are called the increasing rate bonds. So, I mean, you talk about any feature, and there is a financially engineered product available in that segment. So you can have hundreds of financially engineered, I mean, fixed income bonds. So if you look at, if you do a Google search of these things, you'll get a list of hundreds of such kind of bonds. The very popular one is a interest rate swap, where two entities, they agree to swap the interest rate obligations. And why they do it is basically because the different countries they are operating in. Suppose there is a corporation in Singapore, there is one in India. Now the Singapore corporation finds that it is to raise finances in Singapore, it is going to be costly to him, so he can do it in India. So then they can enter into the swap arrangement. The Indian part can raise the finance, and they can enter into a swap arrangement. So the interest rate swap can be done. So like negotiable certificate of deposits. So various other things. I mean, you talk about any requirement, there is a financial engineered product available for that. Now, if you look at, let us say, the the various financial engineered product in the preference or the hybrid segment, then you can look at, let us say, the convertible exchangeable preference stock. Convertible exchangeable preference stock, which is the convertible preferred stock, is exchangeable at the issuer's option for convertible debt with identical rate and identical conversion terms. Okay, so basically the preference share will get converted into I mean the convertible debt at the similar kind of the interest rate is replaced for the preference dividend. You can have the convertible reset debentures, you can have the debt with mandatory common stock purchase contracts, so you can have zero coupon convertible debt also. So these are the in the hybrid segment. Now we look at some of the financially engineered equity products. Now you see the when we talk about your equity product, now see for example, the what happens is equity is the peculiar feature of equity is that they have the control of the company. So basically through voting right, so we know ordinarily that the one equity share carries one vote. But what happens is, if you have, let us say, 1,000 shares, you have 1,000 votes, and suppose your has 100 shares, so he has 100 votes. Now but it is but we see that under Indian law now it is possible for many public limited companies to issue non-voting shares. Now this is something unheard of, because we knew that the equity always comes with a voting right. But why would someone, because equity as such is the riskiest security, because there is volatility in the price, as well as there is variability of the dividend, I mean dividend. You may dividend, you may not dividend. Now why would someone then forego a voting right in order to buy equity? Now, what happens is, in this case, the non-voting shares tend to get more dividend. Now, suppose in the case of announcement of dividend, suppose the company announces a 50% dividend for voting shares, whereas it might announce a 100% dividend for non-voting shares. Now, why would the company do that? Now the non-voting shares is that it gives the enables the key promoter to retain their voting rights. I mean, while they're issuing additional shares, suppose a company is trying to issue additional shares but does not want to dilute the ownership of the company, so what they can do is they can distribute their non-voting shares. So this is one of the examples of the how the financial engineering happens in the case of the equity. Now sometimes you can have different classes of equity shares. Now let us say like class B shares and class A shares. Now the class B shares, they will not get any dividend from the company, or get only 1/10 of dividend of class A shares. Okay. Now typically what happens is the promoters, they would subscribe to the class B shares, whereas small investor would subscribe to the class A shares. Now the because you see the class B share, they will have voting rights and no income, whereas the class A shares, they will have no voting right but income. Okay, so you can have, or you can have, let us say, class B shares. Class A shares, they can for every 10 shares they can have one voting right, whereas in case of class B shares, for every share they can have 10 voting rights, likewise. So the some of the other products that can happen in the equity segment is now the additional classes of share that we discussed, like the company issues a second class of common stock, on which the dividend are tied to the earnings of a specific subsidiary. Suppose you issue a different class of shares, and the income from another subsidiary will decide what should be the dividend payment on this class of shares. You can talk about the America's Trust. Now the what happens in the America's Trust, this is a financially engineered equity product. Now the outstanding shares of a particular company's common stock, they're contributed to the 5-year unit investment trust. Now that means the trust now will decide what should be your capital gain and what should be your the income. So it has a prime component, it has a score component. Now the prime component will embody the full dividend and voting rights in the underlying shares and permit limited capital appreciation, whereas a score component which will it will decide on the full capital appreciation above a certain price. So you can also have the putable common stock. Now the issuer sells a new stock along with the rights to put the stock back to the issuer on a specified date. That means it comes with a put option. We'll just shortly discuss what's a put option. Now we can now talk about the various we can also have, let us say, the master limited partnership stocks. So in equity also, these are equity actually is designed to be high risk. So the concept of the financial engineering to reduce risk is not there, because somebody who is buying equity is coming with the intention of taking higher risk, and so that he gets higher return. So the financial engineering is more prevalent in case of the fixed income security and the derivatives, not that much in case of the equity. Now the last category that we were supposed to discuss is the segment of the financial derivative. Now the financial derivative is a segment which has seen tremendous growth in the recent days. Now, why were financial derivatives they were needed? Now, suppose let us say I'll give you a very short, simple example of from a commodity market. Let us say I am a harvester who produces wheat, okay, and there is my harvest will be ready in, let us say, in the month of December, because December is the the harvesting time. So my entire produce, which could be, let us say, 10,000 tons of wheat, it will be ready in the month of December. Okay, today when we see the, let us say today we are in July, and in July the price of wheat per kilogram is, let us say, currently 50 rupee per kilogram. Now the point is, if the price of wheat remains 50 rupee per kilogram in December, then I will calculate the revenue based on this 50 rupee. Okay, the 10,000 tons into the convert the 10,000 tons into the kilograms, and then multiply that with 50. That will give you the revenue from your produce. Now, this is something that is what I will be calculating. But suppose nobody knows what will be the price of wheat in December. Now, suppose the weather is good and there is a bumper crop this year, and in the month of December, every harvester is ready with a good amount of crop. So, in that case, there is every likelihood that the price of wheat will crash. Let us say it becomes 42 rupee. So, which means that whatever revenue I had calculated, now I'm suffering 8 rupee loss. Of course, the loss is a nominal loss, but there's a 8 rupee loss on per kilogram basis. So, imagine the loss in case of 10,000 kilograms. However, if the crop is not a bumper one this time, but it's because of scanty production, but your technology ensured that you came up with 10,000 tons, but other producers, they have not been able to do that. So there is a scanty crop this time. So there is every possibility that the crop price will, the wheat price will rise. Suppose in the month of December, now the wheat price becomes 55. So you'll be very happy that you had calculated revenue on 50, whereas now you are having 5 rupee per kilogram profit. But nobody knows for sure what will be the scenario in the month of December. So you are exposed to now the price risk of wheat, okay, because and that is a risk that you cannot avoid in due course of time. That is a risk that will come to you. So what can you do to avoid that particular risk? Of course, the concept of the crop insurance and all has come up, but the derivative market is a solution for it. Now this, you are at the one end. Now there is another party, let us say for example a manufacturer or a baker whose the final goods that he sells in the market are biscuits, bread, cakes, these items. So we all know that the raw material for these items is wheat, and that particular baker, he is also exposed to price risk. How? Now, you are exposed to price risk because you are going to sell the product. The baker is exposed to price risk because he is going to buy the product. You are going to sell the product at one go in the month of December, but the baker is exposed to price risk throughout the year because he doesn't buy the raw material in the one go. He purchases in various installments. Now the point is, he's also exposed to price risk. You will be happy if the price of wheat will be, the harvester will be happy if the price of wheat goes up, but the baker will be happy if the price of wheat crashes. Now, these are two interests which are, which have the solution for each other's problem. So, what they can do is they can come together and enter into a contract wherein they sign an agreement that in the month of December, he will buy, let us say, 1,000 ton of wheat from you at a price that is negotiated today. Suppose both of you negotiated the price that okay, today's wheat price is 50, maybe at 49 or maybe at 51, we will do the trade. So you enter into a contract with each other wherein he will buy 1,000 ton of wheat from you at a price of 51 rupee per kilogram of wheat. Okay, and the quality is specified and all that. So you are signing a contract today, but the actual transaction will take place in the month of December. Now, in the month of December, irrespective of what is the spot price of wheat, like it might be 55, it might be 58, it might be 42, 45, whatever. But the actual transaction will take place at the price of 51. So, by entering into a contract, I have reduced, the harvester has reduced his price fluctuation, the baker has also reduced the price fluctuation of the raw material. Now the point is, but of course in the month of December, when the price is different than 51 rupee, someone will have a motivation to not honor the contract. That is a different issue. But the point is, this is the example of a contract, derivative contract, and this contract has a very specific name, which is called the forward contract. So in the derivative market, you can have various contracts. One of the simplest example of the contract that I have given you is the forward contract. Now, this forward contract is done between two parties across the table. So it's an OTC product, forward contract. Now, and for to enter into a forward contract, both the parties must know each other. So which is not feasible many of the times. So what happens is, as I told you, in a forward contract there is obviously the risk that one of the party will default on the day of the actual transaction, because suppose if the wheat price has gone up to 58, then I, the harvester, will have the motivation to default. Whereas if the price drops to 42, let us say, the baker will have the motivation to default. So if one defaults, then though it is legally binding the contract, but the legal process will be very time consuming. So you have basically limited recourse to if the other party defaults. So you have a lot of counterparty risk. So to improve upon that, we did financial engineering, and the forward contract was improved upon through the development of the futures contract. Now the futures contract are contracts which are standardized contracts, and here the quantity of the trade is specified, the price is also specified, and who specifies that? The exchange comes into the picture here. Now the exchange decides the lot size, the exchange decides the price, so that, and here these are all exchange traded products, and the buyer and seller need not know each other in this case. So the futures are a engineered product over and above the forwards. Essentially they both are same, but the forwards are the OTC product, over the counter product, whereas the futures are the exchange traded ones. Then we have the example of something. Now in the case of a forward and futures, both parties have rights as well as obligation. Okay, so like you have to take delivery and give the price. The other party will have to make delivery, and accept the cash. Okay, so the both parties have here have rights and as well as obligations. Now the different category of product is called as the option. In case of option, this is a completely new class of product which has been, again it has been developed through financial engineering. What, for example, let us say I am in possession of some of the shares. Let us say I have some shares of SBI. Okay. Now SBI share is currently, let us say I have 500 shares of SBI. Now the point is, 3 months after 3 months from now, I want to be able to sell some of the shares of SBI, but I don't today. Let us say the SBI shares are trading at a price of 1500 rupee per share. Now I have a requirement of selling the SBI shares not now but after 3 months. Now after 3 months, I am not sure what is going to be the price of. Suppose I know that today is the price is 1500. I am having I am having 500 shares. I need to sell 100 shares of them. So today, if I make the sale, my revenue is going to be 1500 into 100. That is, let us say 1,50,000. But 3 months from now, I'm not sure what is the price at which I'm going to sell. Because if 3 months from now the price of SBI has dropped to, let us say 120 per share, I'm making it 30 rupee loss. So I'm going to sell 100 shares. So I'll have a 3000 rupee loss in 3 months' time, which I don't want to enter into. So what can I do? Can I protect my position here? Yes, I can do that. The options give me that position. Now the options give us the right to, there are two kinds of options. Now here the point is, there is one party of the option that is called the option buyer, and the other party which is called the option seller. Now the seller has sold his right to me, so I have only the right and no obligation, and the seller has only the obligation and no right. So the options could be of two types: the call option and the put option. The call option gives me the right to buy certain item at a certain price in the future date. The put option gives me the right to sell certain item at a certain date, which is decided today. So the typical example that I was telling you, they like the SBI share. Now, if I buy put options on SBI shares at a price of 1500 rupee, I'll have to pay certain amount of money to the person who is selling me the option. So, in lieu of certain amount of money, which is called the option premium, the seller gives me a guarantee that if I want to sell my shares of SBI after 3 months' time at a price of 150, he will buy it from me at the price of 150. And to give that guarantee, he has accepted some amount of money from me. So let us say in 3 months time, now the market price of SBI, instead of dropping, it has gone up to, let us say, 1600 rupee. So I have the option, I don't have the obligation to sell. So in 3 months time, if the price of SBI has gone up, I will not exercise my option, I will sell it in the open market, and the option that I had purchased, that becomes valueless. Whereas if the price of the share drops to 1400, so I will exercise my option and sell the share of SBI to the seller of the option, which is called the writer of the option. So he will have to buy from me at a price of 1400 rupee per share. So he will make a loss, and the entire buying or selling option rests with me, the buyer of the option. So you can have similar kinds of the further financial engineering has happened in case of the options. Like you can have European options, you can have American options. Like the American options can be exercised at any point of time up till the maturity. The European option can only be exercised on maturity. So you have other, innovations that have also happened in case of the various derivative products. So derivatives are seeing day in and day out financial engineering, and newer products are being developed in the derivative segment. That is the reason, also the reason why the derivative market has become 100 times bigger as compared to the spot market or the share market. So basically, the what we discussed in today's class is basically um, various innovations that have been happening in the financial market, so that the the risk faced by the investor is reallocated among various players, and that gives rise to newer and newer products. This process happens through a process called as the financial engineering. So that's all for today. Thank you.